All right, welcome back to the channel. Today we're going to be checking out Murphy's USA, ticker symbol MUSA, and we're going to be revisiting it a little bit. They reported Q3, so we're going to go over that. And, it's been on kind of a tear lately, especially since I made the last video. So, I'm actually, what was that at? I think I made it around, maybe it was like 300, 270 or something like that. But there's been a lot of members in the various Discords accumulating this one in the probably 260s, 250s. And now it's ripped quite a bit. I think my cost basis on it is like 255, 256, something like that. So it's been performing pretty nicely over the last 6 months or so. So let's go ahead and get into the earnings. And I will link the previous video somewhere around here, maybe like over there, right over there, maybe. So check that out if you guys want to. I'll be kind of revisiting the valuation from that video. Not going over it, but just kind of using the same numbers. So let's see. Well, that's Fred. Here we go. All right, so we got Q3 earnings. Net income, $167 million. Year over year, it was down from about 219 to 167, so we saw regression. Kind of expected that when we did the evaluation last time, just with management guidance kind of showing the normalization that was going to probably occur. And then I think they missed on revenue, missed analyst expectations on revenue, and beat on EPS. So I think it had a pretty good move off of earnings, actually. So if we change this to 1 year, let's see what happened. Let's see. Yeah, maybe not. Pretty much flat. So we've had a peak of about $378, a low of $240, and we were lucky to accumulate it around the $255 area. So let's go over to the earnings again. And something that I'm kind of keeping an eye out for is really the sales breakup between gas sales versus convenience sales. And we can see that down here. We've got, let's see, we have a declining in fuel contribution to revenue, pretty significant. So it's, what is that, about a 10% drop or so? A little bit more than a 10% drop from 2022 to 2023. So we've seen a pretty big pullback in fuel contribution to revenue as far as fuel sales. But then we go to merchandise contribution, and we can see an increase in merchandise contribution to revenue, which that's been kind of the my area of focus is, can they use the cheap gas to get people in the door, and then upsell them or sell them on merchandise convenience items in the store. And that's kind of been management's, not guidance, but their philosophy kind of seems like that. Like, use gas to get people in the store, and then take that as an opportunity to try to sell on higher margin goods within the store. So you see a breakdown of non-tobacco, tobacco. So yeah, pretty all right. I mean, nothing spectacular. The interesting thing to me is just the price action lately. Like, it's been on a tear. Now we do see that they have had volumes on sales on a same store basis declined about 4.7%. So they did see a decline. Total retail gallons decreased 2.5%, but then volume on the same store decreased 4.7%. And then on the merchandise side, we've got increased sales of 3%. I think that's on a same store basis, with increasing margins up to 20.1% compared to 20%. So pretty good there. Then we got a dividend of 41 cents per share, or 164 per share annualized, and about a 5% increase from the prior quarter. So dividend increase, yay, if you like dividends. That's pretty cool. Now the interesting thing, and I think this might be why, I don't know, well, energy in general, I feel like is having a pretty good time right now. And MUSA has kind of benefited from that sector strength. But What I think the market could be really looking at is the comparative stats to the overall industry. And that's when I started looking at essentially just sales for the broader market. And so MUSA, or Murphy's USA, was down about 4.7% on a same store sales basis. But then we can go over to Fred here, and we can look at this is percent change from 1 year ago, seasonally adjusted. So we can see that over the last, July, August, September, which would have been the third quarter, we had pretty large declines, 20% down, or almost 21% down in July. August was 8.6% down, and September was 3.3% down. So on a year-over-year basis. So that doesn't make it look too bad when we go back and see that Murphy's USA for the overall quarter just declined 4.7% on a same-store basis. That could indicate that they are a stronger player in this space, and they are continuing to see actually pretty decent performance on a comparative basis to the industry during this kind of pullback that we've seen. So, and yeah, this was another chart that just kind of showed the same thing, but Fred has way better data, and you could do it on a percentage basis. So let's go ahead and jump into the valuation, and we can see that just on an LTM basis, it is starting to expand on the multiples. We're seeing a little bit lower yields on a net income basis, EBIT basis, free cash flow basis, and operating cash flow basis. So if the 5-year average for the net income is 8.14, EBIT is 10.64, free cash flow is 8.14, operating cash flow is 13.69, and on an LTM basis, net income is 6.65, EBIT is 8.74, free cash flow is 5.42, and operating cash flow is 9.31. So we've seen a little bit of multiple expansion off of that. So that's been like kind of interesting. I mean, income statement, we can see that we've had a pullback on a year-over-year basis. 2022 was really, really good, and then we've seen this pretty decent dip, but overall, right, they're still experiencing pretty good growth. We do see that their share buybacks on a percentage basis has kind of started to slow a little bit, and we'll talk about that later on. Balance sheet, basically same old. A little bit of an increase on cash on hand, 133 million, up from about 105 million. And let's see, free cash flow. See, operating cash flow has kind of taken a hit on a year-over-year basis. Stock-based compensation is pretty mild as usual, but let's just go into the valuation, because that's what we're here for, right? So I use Financial Modeling Prep for all of the API queries for my spreadsheets, and I do have a referral to Financial Modeling Prep in the description below. It takes about 20% off of the normal pricing. Additionally, if you want access to this valuation template, you can join the Stone Cold Investors Discord, and that link will be in the description below, and the valuation template is available to all supporters of the Discord. You can become a supporter of the Discord by writing 3 different valuation or company write-ups in the Stone Cold Investors Discord, or if you don't want to do any of that and you just want to lurk around, you can sign up for a $5 a month supporter tier, which will give you access to the channel that has the valuation template. I took basically the numbers I used from the previous valuation of that video that I linked earlier and put them into here, and we can see that in the base case, we've got basically we're normalizing, we have a net income only valuation model, and then we're targeting that 5-year target of about 633 million. So on net income. Now, the interesting thing that's happening right now is we're starting to get probably stretched into the upper end of our current fair value. Now, typically, I think when I did this last time, our base scenario buy point was 250 or 260. And the bearish scenario, or the scenario 2, was around like 220-ish. I was really hoping this was going to get to 220, because I felt like that was like the really, really good sweet spot. But picked up some at 255 and pretty happy with it though. So let's see here. So right now we're looking at around current fair value being 341 to 408 between scenario 2 and 4. And we're sitting at 362. So we're kind of hovering around that fair value right now. And the interesting part with this is that I think I'm going to change these dilution or buyback expectations, because what we should have is we should have actually lower buyback amounts on a percentage basis if the equity is trading at a higher multiple. So what I should really be doing is probably inversing this, doing like, -3 if it's trading at a 6% multiple, and then changing this from a negative to a positive, so we have that reverse correlation. Oh, sorry, no, 3, not, there we go. Here we go. So that would give us about 3.9% buybacks in the best case scenario, which would mean that the market's applying a higher multiple to it. And then in the worst case scenario, with a lower multiple, because the equity is cheaper, as long as they're still buying back shares, they're going to be buying back more for the same amount of cash, right? So you get a higher repurchase amount on a percentage basis. So that changes things up a little bit, obviously, as we can see, because now the upper end scenarios have changed a bit. We get about a scenario 2 buy point of 231, scenario 3 buy point of 252. The worst scenario is 213, scenario 4 is 279, scenario 5 is 311. And then we still have our fair values between, our current fair values between 310 and 445. So it's, I don't know, yeah. It's interesting because we're starting to see this, and we can see here with the bottom line yields, we're starting to see this multiple expansion a little bit. And I don't know if this is just a reversion to a higher multiple, or to a higher multiple, and then maybe we revert back, or, is this going to be a longer term trend of the market applying a higher multiple to this equity, right? So it's interesting. It's still very, very interesting. I mean, they're still buying back a decent amount of shares. Let's see, what was their percentage buyback this quarter? Let's see if we can find that. Share buyback percentage. They repurchased in this last quarter, they repurchased about 0.89% of their float. So 1.41, 0.24, 3. Yeah, so they're still buying back several percentage points probably per year of their float, but it's kind of a catch-22. The higher the price goes up, really the less on a percentage basis they can repurchase. So I don't know. I'm just chilling for now. With this position. I think that it's possible that the strength continues. Like, honestly, I wouldn't be surprised if it went to 425. I also wouldn't be surprised if it went to 300. Nothing would surprise me right now. It looks like they are doing relatively better with their metrics when compared to the overall industry, and I think that's why the market might be trading this at a trading it with strength, or why it's continuing to trade at strength, because it does look like they're outperforming their industry right now. So that's what I got for you guys. Hope you guys have a great Sunday, and we will catch you in the next one. As always, I am not a financial advisor, and none of this is financial advice. This is just my musings on another company and another potential valuation. So I hope you enjoyed it. If you did, please hit the like and subscribe button, and we'll see you in the next one.